In the last lecture, we established the idea that depreciation, depletion, and amortization in accounting do not refer to the decrease in an asset's value over time. Instead, when we use any of those terms in accounting, we're referring to the process of cost allocation. So depreciation is just allocating an asset's cost over its useful life. Now we're going to look at 3 different methods for allocating cost. You'll also see that no matter which method is used, the same amount of cost is allocated, and at the end of the allocation period, the total amount shown as expense on the income statement is the same. Every method starts in the same place, the depreciable base, which is the cost minus the residual value. Let's anchor on one example for the whole video. Suppose we buy a piece of machinery for $120,000. We estimate that the machine will be worth $20,000 at the end of its service life, which is 4 years. So our depreciable base is $120,000 minus $20,000. So $100,000 is our depreciable base. That $100,000 is what amount every method is going to use to allocate. They'll just slice it up differently across the 4 years. Depreciation methods fall into 2 different groups. Time-based methods allocate cost based on the passage of time. Those include straight-line and accelerated methods. And activity-based methods allocate cost based on how much you actually use the asset, units of production. The right choice depends on how the asset actually delivers its value. Does it wear out mostly with time or mostly with use? Let's start with the most common method by far, straight line. Companies use it more than all the other methods combined because it's simple and it's intuitive. You take the depreciable base and divide it by the service life. So $100,000 in our example divided by 4 years equals $25,000 of depreciation expense recognized every single year. Same amount each year, a straight line. After 4 years, we've expensed exactly $100,000 and the asset sits on the books at its $20,000 residual value. That's straight line depreciation. Now, some assets give you the most benefit early in their lives and become less productive as they age. Think of a delivery truck that's more reliable when it's new. For those, an accelerated method makes sense. More expense in the earlier years, less later. The most common of the accelerated methods is called double declining balance. 2 things make double declining balance different. First, we use double the straight line rate to depreciate the asset. So straight line in our example is 1/4. We're allocating 25% of the cost each year. So double declining balance uses twice that, 50%. Second, and this is what trips students up, we apply that rate to the book value, not the depreciable base. And we ignore residual value in the formula altogether. And this is for math reasons. So in the first year, 50% times the full $120,000 cost is $60,000 of depreciation. Notice we did not subtract the residual. In year 2, 50% times the remaining book value of $60,000 is $30,000 of depreciation expense. You can see the expense declines each year, which is why we call it double declining balance. And the one guardrail is that we never depreciate it below the residual value. So we can't let book value go lower than the $20,000 floor. The third method ties depreciation to actual use. With units of production, we compute a rate of depreciation per unit. So depreciable base divided by total estimated units. Say our machine is expected to produce 200,000 units over its life. That's $100,000 divided by 200,000 units, or 50 cents of depreciation per unit. And notice we did subtract the residual value. If the machine produces 60,000 units this year, depreciation will be 60,000 times 50 cents, or $30,000. In a slow year with fewer units produced, depreciation will be lower. The expense rises and falls with usage of the asset, which is exactly the point for an asset that wears out with use rather than with time. Now, let's look at the 3 methods side by side. Straight line gives us an even expense over time, where double declining balance front loads it. Units of production follows usage. The yearly numbers are completely different under the 3 methods, but if you add up any column and you get the same $100,000 of total depreciation. And every method lands the asset at the same $20,000 residual value at the end. The method is purely a choice about timing. This is also why you have to be careful comparing 2 companies' earnings if they use different depreciation methods. The difference you're seeing may be method, not performance. One practical wrinkle, assets rarely get purchased on January 1st. If we buy that machine on April 1st, we only owned it for 9 months of the first year. So under straight line, we'd record 9/12 of a full year of depreciation. So $25,000 times 9/12. or $18,750. We just prorate for the portion of the year that we use the asset. The same logic applies to the other methods. Some companies simplify this with conventions like the half-year convention and just do half in the first year regardless of the months owned. But the basic idea is simple: depreciate it for the time that you actually owned and used the asset. To wrap up, every method allocates the same depreciable base, cost minus residual value. Straight line spreads it evenly, double declining balance accelerates it at double the straight line rate applied to book value, never dropping below residual. And units of production ties expense to actual usage. All of them reach the same total over the asset's life, only the timing differs. And when an asset is bought mid-year, we prorate that expense. Next, we'll see what happens when we get rid of the asset and why selling it almost always produces a gain or a loss.